You gotta save and invest your money. Save and invest your money. Save and invest your money. What's up, YouTube? I'm William Bitter. I live in downtown New York City, where I own and operate a dog walking business. I've managed to save about 80% of my income and invest it, and I'm starting this channel to talk to you guys about saving and investing and how this can lead to financial freedom. What if I told you you could turn $1 into $40 simply by saving it and investing it? You're probably thinking this sounds too good to be true. Here's the catch. In order to 40x your money, you would need to start investing it at 18 years old and invest it for a total of 60 years. This is an extreme example, but it's meant to show you the power of saving and investing as well as compound returns. Basically, your money grows exponentially. So the sooner you start investing it, the better. I use the S&P 500, which makes up about 80% of the US stock market. It's easy to invest in through various ETFs, such as SPY, which is the largest ETF in the world. So basically, the compound annual growth rate of the S&P 500 since its inception in 1957 through the end of 2019 has been 10.27%, or 6.44% after adjusting for inflation. We'll be using the compound annual growth rate adjusted for inflation because we don't really care if we end up with $100 million by the time we retire, if that $100 million is really only worth $10 million. So it's really important to use the compound annual growth rate adjusted for inflation. This better reflects the real value growth rate of your investment. Let's look at this chart that I created given a $100 investment at 18 years old with a 6.44% compound annual growth rate. Given a $100 investment at 18 years old, by the time you're 28, 10 years later, you'll have $186. By the time you're 38, you'll have $348. By the time you're 48, you'll have $650. By the time you're 58, you'll have $1,213. By the time you're 58, you'll have $2,265. And by the time you are 78 years old, you'll have $4,229, which is just over 40 times what you started with. The sooner you invest, the more growing potential your money has. If you wait 10 years to invest the same $100, investing it at 28 instead of 18, your money will only grow to about half as much as it did if you would have invested it at 18, 10 years earlier. Assuming this is your only contribution to retirement, that means that your passive income at retirement would have been twice as much had you just invested that $100 10 years earlier. Another way to look at it is you could reach retirement 10 years earlier. The person that would have invested that $100 10 years earlier would have that same amount 10 years sooner. However you want to look at it, you'll likely have to work just as hard to earn, save, and invest that $100 now or 10 years from now. You get a much better bang for your buck by saving and investing it right away. This bang for your buck could come in the form of 10 more years of retirement or twice the passive income at retirement. However you want to look at it, you always get a better bang for your buck by investing sooner rather than later. It's kind of similar to the Stanford marshmallow experiment, where they basically take a kid and put a marshmallow in front of them, and they tell them, if you can wait 15 minutes and not eat this marshmallow, we'll come back and give you another marshmallow. The kids have a hard time waiting, but the ones that have patience are rewarded with 2 times as many marshmallows. Thinking of saving and investing for retirement can sometimes be daunting, and it's easy to get dissuaded with no upcoming reward in sight. I recommend starting with small goals first, like saving and investing enough to pay your cell phone bill for the rest of your life. If your cell phone bill is $45 a month, 45 times 12 is $540 a year. Divide 540 by 0.0644, which is the compound annual growth rate of the S&P 500 adjusted for inflation. This comes out to be $8,385, which is how much you'd need to save and invest for your return to more or less pay your cell phone bill for the rest of your life. Then what I like to do is play with the investment calculator to come up with a plan on how to save and invest $8,385. I'll leave a link to this investment calculator down below in the description. Eventually, your goal will be to save and invest enough to cover all your expenses. Also, super important to know that if your income is under $40K, you pay no tax on your long-term capital gains. Long-term capital gains are investments held for at least a year. Even if your income is more than that, long-term capital gains tax is much less than income tax at just 15% and 20% when you make much more. Investing has never been easier. All you need is a few dollars and a smartphone to get started. 3 of my favorite investing apps are giving away sign-up bonuses. Robinhood is giving away 1 free stock when you sign up. Webull is giving away 2 free stocks when you sign up and transfer money. One of the stocks could be valued up to $1,400, and M1 Finance is giving a $10 sign-up bonus. M1 Finance is also offering a pretty large payout for transferring stocks from an existing brokerage account, up to $2,500. I've included links to all of them below. Please click the links if you want the sign-up bonuses. It doesn't matter how old you are. The important thing is that you start investing sooner than later. It's never too late to start investing. I hope you guys are as excited about investing your money as I am, and I hope we all get to build wealth together. The purpose of this clip is to get people excited about saving and investing. Without going too much into detail, there are a couple things that I want everyone to be careful of when investing their money in the stock market. You want to make sure that you have an emergency fund with at least 3 to 6 months worth of expenses, just in case something happens. You don't want to be forced to sell your stocks in a market dip just because you're tight on cash. Many people don't invest in the stock market because they've seen the markets tumble like 50% and they're terrified. So what I have to say is the only people, not the only people, but generally the people that lost money during these market dips were the people that panicked and sold. Everyone that's held on to their money held on to the stocks that they owned during these dips, the majority of them came out ahead. If you just look at, the S&P 500, the historical prices, you can see that everyone that's held on to it has always come out ahead in the long run. So it's important to think long run. Don't panic and sell when the market dips. If anything, buy more. And of course, do this all at your own risk. An important disclaimer is that I'm not a financial advisor. Past performance in the stock market does not guarantee future performance, and I would encourage everyone to do their own research and, invest at your own risk. And good luck to everyone. I'd like to make some more videos about saving, budgeting, living frugally. I save and invest about 80% of my income, and striving for a higher and higher percentage every year. And I want to show you ways that I do this. I feel like living frugally and saving is where we can get super creative. You gotta save and invest your money. Save and invest your money. Save and invest your money. Double your money. You gotta save and invest your money. Save and invest your money. Save and invest your money. Double your money. Double your money. Double your money and then double your money. Gotta save and invest your money. 100x your money. Investing in the stock market never been easier. So I use moneychimp.com to find the compound annual growth rate of the S&P 500. The reason that we don't use average annual returns is because this doesn't reflect the true return of your investment. Basically, if you invested $100 and it went up by 100% one year to $200 and then went down 50% the next year, bringing it back down to $100, basically you're right back where you started 2 years ago. So your compound annual growth rate is 0%. However, your average annual return is 100 plus negative 50, which is 50, divided by 2, which is 25%. So basically your average annual growth rate would be 25%, which doesn't make any sense if your investment of $100 is still $100 at the end of 2 years. So you see why we need to use compound annual growth rate instead of average annual return. So hopefully this clears things up a little bit.